Everyone says SCHD is the king of dividend ETFs. But what if I told you there's a fund that challenges SCHD and puts more cash in your pocket every month? Today we're uncovering a dividend ETF most investors don't even know exists, and it might change how you think about income investing. Now let's start with SCHD. It's become the poster child of dividend investing, with everyone bragging about holding it. Sure, SCHD has earned its reputation. It's steady, disciplined, and feels like the responsible adult in the room. But just because it's reliable doesn't mean it's unbeatable. Sometimes the hyped option isn't the best for your goals. SCHD is a great product that selects U.S. companies known for strong dividend payments and filters out weaker options. It offers a basket of businesses that consistently pay dividends and even grow those payments over time. Investors prefer SCHD for its affordability, simplicity, and stability during market fluctuations. However, SCHD isn't built to maximize your income, but rather to balance safety and yield. The yield hovers in the mid-threes, possibly reaching 4%. Respectable, but not necessarily life-changing for income dependence. An extra percentage or two can make a significant difference for those relying on dividends for living expenses. What if there's an ETF that delivers that extra punch? Not just a little more, but a lot more. That's where JEPI comes in. If SCHD is your responsible friend who organizes their receipts, JEPI is the bold cousin who turned a side hustle into full-time income. This fund adds a clever twist. It layers on an option strategy, selling covered calls and using structured notes to collect premiums. JEPI takes the normal dividends it earns and supercharges them with extra cash flow from selling those options. Think of it as running a rental property where you collect extra fees by renting out the driveway. That's why the payouts from JEPI are way higher than the vanilla dividend ETFs you're used to. JEPI's yield typically hovers around 8%. That's often double, sometimes nearly triple what you'd see from SCHD. JEPI pays out every single month instead of once a quarter. Cash landing in your account with a regular rhythm. For income-focused investors, that frequency makes a real difference. It feels like a reliable stream of money. Monthly payouts allow you to manage cash flow for bills, groceries, and more. It creates a sense of stability. That steady drip of income smooths out your spending, making you feel like your portfolio works for you every month. Psychologically, that rhythm feels more dependable and rewarding than quarterly dividends. The higher yield comes with trade-offs. When the market takes off like a rocket, JEPI doesn't capture the full upside because of those covered calls. Think of it like this. You own a house and someone pays you rent for the option to buy it at a certain price. You pocket that rent money no matter what. If the house price stays flat, you're happy because you've got the rent. If it dips, that rent cushions your losses. But if the house price doubles overnight, you miss out on some extra upside because you sold the right for someone else. You trade away potential capital gains in exchange for more consistent, higher income. Depending on your goals, this might be a perfect deal or a terrible one. If you're 25 and stacking your portfolio for growth, maybe you don't want to cap your upside. You'd rather let the rocket ship ride. What matters isn't theoretical gains you might have had. It's the steady, reliable cash you can actually spend. JEPI's design fits that need beautifully, allowing for monthly payouts that take care of expenses. It transforms investing from a long waiting game into something that directly supports your lifestyle today. But wait, there's another wrinkle here. SCHD's dividends are almost all qualified, leading to lower tax rates. JEPI's income comes partly from option premiums, which may be taxed as ordinary income. After taxes, the gap may shrink, which is something a lot of people don't consider when comparing yields. FDVV, Fidelity's high dividend ETF, focuses on large U.S. companies with high dividend yields, offering good old-fashioned dividend collecting. Its yield is smaller than JEPI's, but the growth rate of those dividends has been solid. FDVV quietly delivers value. Think of FDVV like the middle child here. Not as flashy as JEPI, not as mainstream as SCHD, but steadily building a track record. DIVO, the Amplify Comprehensive Dividend Income ETF, uses a covered call strategy and picks about 30 blue-chip names. DIVO's yield is usually in the 5 to 6% range, offering solid returns without the complexity of other options. Some even call DIVO JEPI's calmer cousin, less yield but also less complexity. VYM, Vanguard's high dividend yield ETF, focuses on wide quantity rather than just quality. It holds a basket of high-yielding companies. Its yield usually lands around 3% to 3.5%, providing a solid core option for those seeking exposure without much risk. HDV, iShares Core High Dividend ETF, screens for sustainable dividends and financial strength, targeting yields of 3.5% to 4%. Like a buffet, SCHD chooses the healthiest options, while HDV focuses on proteins with its more sustainable dividends. HDV offers a different flavor of holdings, making it a great alternative when comparing options like SCHD and VYM. That depends on what better means to you. If you define better as the most cash in your pocket every single month, then JEPI is probably the winner. If you define better as a balance of stability and growth without too much risk, SCHD still has the edge. If you define better as dividend growth plus solid total returns, FDVV sneaks into the conversation. Each of these funds is playing a slightly different game, and the one that's right for you depends on what you actually want out of your portfolio. SCHD is the friend who always shows up to help you move, but only drinks water and never stays past 9. JEPI is the friend who makes the party fun, brings the good snacks, and sometimes gets you into questionable adventures. FedVV is the friend who doesn't say much, but quietly gets promoted every year and just keeps stacking wins. You can like all three, but the one you want in your life most depends on what you value. JEPI's monthly income feels like a second paycheck with a yield around 8%, making $100,000 spin off roughly $8,000 a year. Over $600 can slide into your account every month, covering rent or groceries without selling shares. Unlike JEPI, SCHD doesn't provide the same level of cash flow, but has a different long-term strategy. Skipped focuses on businesses that grow their dividends consistently, leading to compounding income over time. As time passes, the income gap between SCHD and JEPI could shrink, with SCHD's growing dividends potentially leading to greater income. JEPI is like having your cash flow machine cranked to the max today. Fantastic if you need money now and don't care as much about long-term compounding. SCHD plays the long game, rewarding patience with growth that can snowball in the background. FDVV balances both approaches, higher dividends than SCHD and more room for growth than JEPI. Investing isn't just a math problem, it's about building something that fits your life. Ask yourself, do you need steady cash each month or prefer to let dividends pile up quietly for future security? These choices aren't mutually exclusive. You don't have to plant your flag in just one camp. Smart investors keep SCHD as their reliable long-term anchor and sprinkle in JEPI for monthly cash boosts. This combination gives you stability of a core holding, plus the excitement of extra cash flow, like a steady salary and profitable side hustle. Some build around FDVV, not chasing the highest yield, but aiming for consistent dividend growth, stacking up over the years. Understanding each ETF's role in your portfolio is the key. Tailor your strategy to your financial story, rather than following the crowd. For income-hungry investors, JEP absolutely delivers more money in your hand. For long-term compounding, SCHD might still come out on top. For people who like a little of both, FDVV deserves a look. Other flavors of dividend income include DIVO, VYM, and HDV. At the end of the day, ask yourself, do you want the biggest cash flow right now or a sustainable plan for the future? Both choices are valid. Steak tonight or raising the cow. Imagine walking into a giant supermarket filled with thousands of products. It's overwhelming, right? That's what investing feels like for many people. You open up your brokerage app and there are thousands of stocks, hundreds of ETFs, and countless opinions on which is the best. Some people swear by Tesla. Others say Apple is the only stock worth holding. SCHD has become a cult favorite. There are other options, often better ones, if you look a little deeper. In 2025, it might not be SCHD. SCHD, the Schwab US Dividend Equity ETF, gained massive popularity because it offers solid dividend-paying stocks and a low expense ratio. But here's the catch. SCHD is built for yesterday's world more than tomorrow's, leaning into sectors like consumer staples and financials. If SCHD isn't the one ETF to buy in 2025, where should you look? Understanding growth areas is essential. Experts recommend ETFs tracking broader markets or innovative sectors. A top pick is VOO, the Vanguard S&P 500 ETF. VOO provides instant access to 500 of the largest U.S. companies, from Apple to Amazon. It's buying the entire economy's growth. While SCHD offers dividends, it limits upside in a world dominated by innovation. VOO opens doors to tech leaders and pioneers. What about more specialized options? QQQ, following the NASDAQ 100, focuses heavily on tech and growth. For long-term growth, consider QQQ. If you believe in AI, green energy, and biotech, higher volatility means greater potential rewards. Let's address the elephant in the room: dividends. One reason investors love SCHD is its juicy yield. Those quarterly checks provide comfort. But a 3 to 4% yield means little if your portfolio lags the market. Would you take $3,000 in dividends or watch $100,000 double in 10 years? VOO or QQQ may offer smaller dividends, but their growth potential can exceed SCHD's payout significantly. Next, let's talk about diversification. SCHD's sector concentration limits your protection. In 2022, it held up, but it lagged in 2023 to 2024 as tech rebounded. By choosing broader funds like VOO or growth-oriented ones like QQQ, you diversify across industries and align with future opportunities. Finally, consider the global outlook. Supply chains are changing, and emerging markets like India are gaining strength. Diversification beyond US borders is crucial. In 2025, one investor buys SCHD for perceived safety and steady dividends, while another invests in VOO or QQQ, aiming for growth. Fast forward 10 years, and the SCHD investor has steady checks, but the growth investor sees their portfolio double or triple. Once your portfolio grows, you can switch to income-focused ETFs later. Growth first, income later is smarter for under-retirement age. Humans love certainty, which is why SCHD feels good. But investing is about long-term outcomes, not immediate gratification. Choosing VOO or QQQ requires patience, as you won't get instant dividends, but you're positioning for greater long-term success. CHD's popularity on social media doesn't equal performance. Trendy investments often signal diminishing returns. CHD has done fine, but hasn't matched VOO or 2QQ's decade-long performance. Future growth is driven by technology and healthcare. If I can only buy one ETF in 2025, it's either VOO for long-term growth or QQQ for innovation, not SCHD. Investing aligns your money with the future. SCHD offers stability but represents yesterday's economy. VOO and QQQ provide exposure to technology, innovation, and global growth. Invest where the growth is. Don't just pick the popular ETF. Consider where your money will work hardest for you. Leaning on SCHD could hold you back in 2025 as the global economy evolves towards resilience and technology. Broad market ETFs like VOO or growth-focused like QQQ give you exposure to the leaders of tomorrow. Millennials and Gen Z are stepping into prime earning years. Their preferences are reshaping markets, focusing on tech, sustainability, and digital transformation. Billions in capital towards sustainable industries mean broader market ETFs benefit more than dividend-weighted products like SCHD. Younger consumers prefer Tesla over Ford and plant-based proteins instead of meat, creating ripples across industries. Innovations in ETFs include active strategies, thematic ETFs, and global funds. Ignoring these can close investors off from rising opportunities. Volatility could be an opportunity for long-term investors. It allows buying shares at lower prices, unlike safer, less volatile investments. Avoiding volatility often leads to missing out on growth. Just like a roller coaster, riding the market's ups and downs can lead to greater rewards. We need to address the inflationary backdrop. The 2020s are shaping up to be a decade of higher structural inflation than the 2010s. Governments are spending heavily on infrastructure, defense, and climate initiatives. That money often fuels sectors like energy, technology, and materials. Funds like SCHD may capture a slice of that, but don't give you the full benefit of those policy-driven growth stories. Broad-based ETF like VOO captures all of it, holding a little bit of everything, including companies benefiting from government spending. Let's not ignore the rise of China, India, and other emerging economies. The future will be multipolar. While the US remains dominant, Companies in India are growing rapidly, especially in tech and manufacturing. If you only hold SCHD, you're blind to developments in India, Africa, and Latin America. Adding ETFs like VXUS or VWO ensures a broader perspective. Investors often feel comforted by dividends, luring them into complacency. This can lead to holding on to a mediocre investment, even as the opportunity cost grows. Prioritize total return first, then shift to dividend-focused funds once your portfolio grows. Growth first, income later is the way to build wealth. We are in the early phases of AI, quantum computing, and renewables. Ignoring these megatrends is akin to missing out on the internet boom. ETFs like QQQ and thematic funds like ARKK provide exposure to innovations. SCHD may leave you behind in the evolving market landscape. Historical returns show that growth-focused indexes outperform dividend-focused ones over time. Stability versus wealth. Choose wisely. You know that sinking feeling when you open your portfolio and one of your favorite investments is just sitting there? That's been the vibe for a lot of SCHD investors this year. I get it. But before you rage sell and move your money into whatever's trending, let's understand what's really going on with SCHD. A few months back, I felt good about my dividend ETF until suddenly the music stopped. Growth stocks were soaring while SCHD felt stuck. Instead of dumping shares, I decided to go full detective mode and understand why this ETF, based on quality and income, seemed static. This rabbit hole completely changed how I view SCHD today. On the surface, around $27 to $28 a share, and a 3.7% dividend yield. Not bad, but compared to Treasury bills, it looks lackluster. SCHD was designed for reliable income and steady growth, not for chasing momentum or flashy charts. This year looks worse than usual due to March 2025's big portfolio reshuffle, changing roughly 20% of its holdings. Energy now constitutes over 21% of the fund, up from about 12% last year, with key players like ConocoPhillips and Schlumberger. While retail investors might groan about oil before a downturn, institutional investors see opportunities. Energy companies are trading at attractive valuations in over a decade. They may not be glamorous, but they throw off massive free cash flow. These are not struggling companies. They're just unpopular right now, and that's an opportunity. In 2020, no one wanted energy stocks, but as oil prices rose, those unloved stocks outperformed. Let's address the elephant in the room. Why own SCHD when a 4% savings account is available? Savings accounts are safe, but they don't grow purchasing power. Inflation eats away at gains. SCHD offers dividend growth and capital appreciation, essential for outpacing inflation and building wealth. Contrarian positioning gets interesting. By increasing its energy exposure while dialing back financials, it's zigging, while many dividend ETFs zag. While others like VIG and VYM lean harder into banks and healthcare, SCHD is doubling down on sectors that are deeply out of favor. These sectors are lagging while everyone piles into tech and AI. The market is a pendulum, and overlooked sectors will rise again. Investors often fixate on price action, but total return, including dividends, paints a different picture. Even in a bad year, SCHD pays about 3.6% in income. Reinvesting dividends allows for compounding, building wealth over time. Over the last 18 months, my SCHD position showed a subtle but powerful truth. My total return, with dividends reinvested, was slightly positive. I've accumulated more shares without adding new money. That snowball effect is the heart of dividend investing. Institutional investors aren't panicking. They're accumulating because 6 months of underperformance means nothing if your horizon is 10 or 20 years. SCHD holds companies with strong cash flows, healthy balance sheets, and a long history of paying dividends. It's diversified across essential industries. When thinking long-term, you want hated sectors with attractive valuations and a reliable income stream that rewards your patience. It's tough watching an ETF underperform, but investing is not about quick results. It's about building something resilient. This ETF isn't designed to be a rocket ship. It's a workhorse, and workhorses look boring until the market conditions flip. The very same factors that make SCHD feel sluggish today are the ones that give it a massive edge tomorrow. One crucial factor is interest rates. When short-term rates are high, dividend stocks naturally lose appeal. That's the logic driving a lot of investor decisions right now. But that logic falls apart as the macro environment changes. The Federal Reserve isn't going to keep rates this high forever. Dividend-paying stocks suddenly look more attractive. Some of the smartest institutional money is quietly using this period as an accumulation phase. This is where dividend reinvestment becomes a secret weapon. Many underestimate its true power. Every quarter, SCHD pays you. By reinvesting those payouts, you're constantly buying more shares at different prices. Sometimes you grab shares at a discount when the ETF is down, and sometimes fewer when it's expensive. Over time, this dollar cost averaging on autopilot creates a powerful compounding effect. Let's address the risks. SCHD's exposure to energy is a double-edged sword. It offers upside, but also potential downturns. Healthcare offers stability, but is vulnerable to regulatory changes. Consumer staples face margin pressures. SCHD isn't betting on speculative companies with shaky balance sheets. It's anchored by businesses with strong fundamentals. That quality focus doesn't eliminate volatility, but it does create resilience. Resilience is what you want in an ETF for long-term wealth. You're buying SCHD for the next 10, 15, or 20 years, during which sectors will rotate and market leadership will change. SCHD offers exposure to different parts of the economy: energy, healthcare, and consumer staples. Diversification is about consistency and protection. It ensures one bad earnings report doesn't sink your entire retirement plan. SCHD plays an important role in my own strategy. It's the ballast that keeps my portfolio steady when markets get choppy. Even when it's not dazzling with returns, it's still paying me every single quarter to be patient. The narrative around SCHD today is eerily similar to stories we've heard before. In 2000, value stocks were declared dead right before they massively outperformed. In 2008, defensive sectors became havens of stability during the crisis. Selling during these boring periods is often the worst move. It's like chopping down a tree before it bears fruit. The beauty of an ETF like SCHD is that you don't have to time the rotation perfectly. Just stay invested, reinvest your dividends, and let the cycles do their thing. When they do, it usually happens faster than most people expect. One quarter, the market ignores dividends, and the next, everyone chases yield again. Every reinvested payout builds future gains, while every boring quarter you stay the course sets you up for a bigger payoff later. It's about building a foundation with SCHD that throws off income, compounds steadily, and reduces risk across decades, not weeks. Wealth isn't built in exciting moments. It's built in quiet ones, by holding on to investments and reinvesting dividends quarter after quarter. Underperformance often doesn't mean something is broken. The market's attention can shift, but it always comes back. SCHD has a decade-plus track record of consistent performance across economic cycles, weathering recessions and market rotations. SCHD was built to steadily compound wealth while you live your life. Compounding over time leads to powerful results. Owning 500 shares generates dividends each quarter. Reinvesting those dividends buys more shares, creating a snowball effect. The real superpower of SCHD is the yield on cost you earn many years from now as dividends grow with reinvestment. Let's talk about portfolio strategy. SCHD truly shines when used correctly. The best portfolios usually have both growth and income. Growth stocks offer explosive potential. Dividend ETFs like SCHD provide stability, income, and balance. They complement each other. In my portfolio, SCHD isn't competing with growth. It's balancing it. SCHD's steady income keeps me grounded during market surges. It's the ballast that keeps the ship steady while the sails catch the wind, allowing me to stay invested. Patience is the most underrated skill. Investors underperform due to impatience, selling too soon, instead of letting compounding work. SCHD rewards patience. Understanding boring fundamentals like sector allocation and dividend policy is crucial. SCHD's focus on essential sectors ensures its staying power. Even the risks look different when you zoom out. Sure, energy exposure could hurt if oil collapses, but those risks don't make SCHD a bad investment. They just make it a long-term investment. Quality companies tend to adapt, innovate, and keep rewarding shareholders over long time frames. Institutional investors aren't dumping SCHD in frustration. They're accumulating shares and reinvesting dividends, waiting for the next cycle. Markets are forward-looking and cyclical. Today's laggard is often tomorrow's leader, and that's the bet with SCHD. You might be sitting on one of the most quietly powerful opportunities in your portfolio. The price might not be skyrocketing, but the dividends are still flowing. It's easy to fall in love with the stocks that double in a year, but the investments that change your life rarely feel exciting while they're working. The question isn't whether SCHD will explode next quarter, but whether you're willing to let time and dividends do their job over the next decade. Look back on this boring stretch not as a disappointment, but as the foundation of your financial independence. Patience isn't just a virtue, it's a strategy. It's the reason portfolios grow and wealth compounds. If you found this breakdown helpful, stick around for our next video on how dividend investing can transform your long-term returns. You know that feeling when you check your portfolio, expecting a little lift, and it's just flat? That's where I've been lately with SCHD. I bought it for stability and steady dividend income, but lately it feels glued to the floor while the market soars. If you're holding SCHD, you've probably wondered, is it broken? Has something gone wrong with this fund? I want to show you why there's real data behind this lag. Let's start with the biggest force in the market right now. That gravity is the Federal Reserve's interest rates, the single most important reason the fund looks weak today. Imagine you've got $1,000 to invest. A few years ago, safe income options were limited, and treasury bonds paid next to nothing. People turned to dividend-paying stocks like SCHD, viewed as bond proxies with higher payouts and growth potential. Then inflation surged, and the Federal Reserve aggressively hiked interest rates. Suddenly, government bonds became attractive again. You can now buy U.S. Treasury bonds with nearly a 5% yield, risk-free, and backed by the U.S. government. SCHD holds high-quality dividend-paying companies, but stocks always come with risk. Why take that risk when you can earn 5% safely? You've got ultra-safe government bonds waving a guaranteed return in your face. On the other, you've got SCHD, a portfolio full of proven companies with uncertainties. The decision really depends on your time horizon and your tolerance for watching the market do its little dance every day. SCHD's strength lies in what can't be seen from a single month or quarter. These companies have real earnings power, generating cash year after year. They sell products people use every day: toothpaste, broadband, oil. Things that don't vanish in a market correction. Income investors are chasing the sure thing. It's not that SCHD became risky. It's that the baseline for safe returns moved higher. Humans crave safety. A guaranteed 5% feels comforting in uncertain times. But inflation slowly erodes that return over time. Dividend payers provide growth that bonds don't offer. Dividends can rise and share prices can appreciate, leading to massive long-term gains. From a short-term view, bonds seem like the easy win, but SCHD plays a longer game. It rewards those who understand time in the market beats timing. When interest rates drop, the bond yields will shrink. Investors seeking safety will start searching for better opportunities, leading them to SCHD. SCHD's current underperformance is setting up for potential outperformance. It attracts the quality cash flow and consistency investors seek. Investor fear turns into greed, and market leadership rotates. Back in the early 2000s, tech stocks ruled. Then, value took over. In the 2010s, growth made a comeback powered by low rates and innovation. Now, we see another tech-driven surge. Nothing in markets stays dominant forever. The narrative shifts quietly at first, often unnoticed, until halfway through. SCHD sits at that turning point. It's not flashy, but it's preparing for the next phase, consistently raising dividends. When rates fall and growth hike cools, that pent-up reliability becomes momentum. Investors have short memories. When risk-free bonds yield less, funds like SCHD will look irresistible, with a 3.8% dividend yield and growth potential. SCHD's design rewards patience. Its rules ensure only profitable, financially sound companies are included. When the market mood shifts, it benefits from fundamentals like earnings power and payout stability. I think of it like a tide going out and coming back in. What looks stranded will come back to life. SCHD has been waiting for the tide of capital to return. When it does, the move could be sharp. In moments like this, patience isn't passive. It's strategic. Investors who hold through will end up on the right side of history. Patience in investing isn't about doing nothing. It's about understanding what you already own. Compounding takes time, and that time is the advantage most people waste chasing the next big thing. SCHD rewards those who can sit still when everyone else is jumping ship. Each dividend check proves the strategy is still working. Investing isn't about what's hot right now. It's about owning what endures. SCHD is filled with businesses that endure. If I can get 5% from a treasury, risk-free, I need to ask, what's SCHD giving me for that extra uncertainty? I'm buying exposure to great companies that can grow their dividends over time. That growth justifies the risk. For many investors, especially retirees, that steady 5% from the government is like a siren song. It's safe, simple, and stable. SCHD can be frustratingly slow right now. It's like watching grass grow while your neighbor's garden is exploding with flowers. The truth is, risk and reward are always a trade-off. I can play it safe or invest in companies generating profits. I'd rather own something that can evolve than something that just sits still. The potential for growth is key. For SCHD to be attractive, its dividend yield must compete with that risk-free 5%. The yield is calculated by annual dividend over price. The only way for the yield to go up is if the stock price goes down or stays flat. That's the market reality. The market has established a price ceiling for SCHD due to income investors seeking safer, higher-yielding alternatives. The gravitational pull from interest rates suggests SCHD's price will remain capped until the Fed signals a rate decrease. While SCHD is capped, tech stocks are thriving. The S&P 500 shows nearly 20% annualized return, driven by a few mega-cap tech companies. Companies like NVIDIA, Microsoft, and Alphabet have propelled the index higher by leveraging advancements in artificial intelligence. SCHD's rules prevent it from capitalizing on speculation. Companies must meet strict entry requirements, including 10 years of dividend payments. Companies like NVIDIA or Tesla don't fit that mold. They're reinvesting every spare dollar into growth. They're not paying dividends, and they're not trying to. SCHD automatically filters them out. It's built to find mature, stable companies that have proven themselves and can share profits with shareholders. While the AI boom has driven the S&P 500 to new heights, SCHD has been left sitting quietly on the sidelines, sticking to its discipline. If you've been holding SCHD during this tech-driven period, it's felt frustrating. It's underperformed, but that's by design. The SCHD you hold today isn't the same one you owned last year. It has undergone a massive transformation under the hood. Every March, SCHD rebalances its portfolio based on its rules. Completely unemotional, purely mechanical. This year, that algorithm kicked out 23 companies and added 23 new ones. That's a 20% turnover, for a typically stable ETF. And the changes it made were telling. It removed some popular names, not because they were bad businesses, but because their stock prices had soared high. SCHD's algorithm looked at that and said, "You're no longer a high dividend stock, you're out." It also dropped companies like Pfizer and BlackRock, probably because they failed one of the financial health screens. On the flip side, it added names like Hershey, classic, steady consumer companies, and made a huge move into the energy sector. Energy is now SCHD's largest sector, making up nearly 20% of the portfolio. That's a major shift. Now it's tilted towards cyclical energy companies like ConocoPhillips, whose performance is tied to the health of the economy. SCHD's personality has changed. It's not just the quiet defensive dividend fund, it's got more cyclical exposure now. If oil prices rise and the economy stays strong, this could be a huge advantage. But if energy prices fall, it could sting. When I first realized how much SCHD had changed, it surprised me. I'd always thought of it as a slow, predictable, conservative play. This rebalance really shook things up. It's not necessarily a bad thing. It's just different. We need to understand what we actually own. SCHD's price has been held down by interest rates and left out of the tech boom, now carrying more energy exposure. What does this mean? I don't think it's time to sell. I believe SCHD might be setting up for a recovery, and here's why. The first reason is market cycles. Leadership in the market is cyclical. Tech doesn't dominate forever. Rotations between growth and value happen. The second reason is monetary policy. If the Fed's interest rates start to come down, SCHD's yield of around 3.8% looks attractive. Income-focused investors flood back into dividend funds. Prices rise, yields compress, and we see steady appreciation that's been missing. Morningstar rates SCHD as one of the best dividend funds, calling it sensible, transparent, and risk-conscious. Three main scenarios for SCHD. First is a soft landing, where the economy cools and the Fed can cut rates. In the second scenario, strong economy with sticky inflation. SCHD's performance remains muted, but benefits from strong earnings. The recession scenario would likely cause SCHD's price to fall, but it could still outperform the overall market. A bottom-up analysis of SCHD's holdings looked at Wall Street's 12-month price targets for every stock inside the fund. The average implied upside is 10.8%. Analysts believe the companies in SCHD's portfolio are undervalued and have room to grow. SCHD isn't broken, it's compressed. Factors like high interest rates, the AI hype cycle, and its portfolio shift explain its current weakness, but don't define its future. When rates eventually fall, and when the market rotates back to value, SCHD will likely come back into favor. Until that turning point arrives, long-term investors are holding their ground. SCHD was never meant to be a get-rich-quick play. The dividends continue to flow, supported by solid fundamentals. Many see it as stored potential, waiting for the right moment. SCHD looks weak right now, but it's resting, recalibrating, and getting ready for its next leg up. I want to already be in the game, not chasing after it once it's already moving. Are you holding, buying, or selling SCHD right now? Drop it in the comments. Let's talk about it.